Imagine if every dollar you owned could really be used for your benefit, like a small worker supporting the construction of your future. Actually, the stock market operates precisely like that. You absolutely do not need a fortune to start, and you are not a Wall Street guru either. Today, we will dissect the true nature of the stock market, explain why it is not as frightening as it first seems, and show you how to start making your money work smarter rather than harder. So stay around to witness how common people are accumulating their riches. 1. Meaning of the stock market. Imagine entering a massive market, and instead of sellers of goods or fruits, thousands of businesses are presenting small bits of their operations. The stock market is really just a venue where individuals can acquire shares of a corporation. Purchasing a share means buying a tiny portion of that business, like having a slice of pizza. The price of your share might rise as the business expands and gains more value. If it suffers, though, the value of your share could decline. Owning even a small portion of the company lets you participate in its journey and maybe increase your wealth as it expands. 2. Why individuals purchase shares. Individuals purchase shares simply because they like their money to increase, and traditionally the stock market has provided some of the finest returns over time. With shares, your primary income sources are dividends and growth potential. Growth potential refers to the tendency wherein the value of your shares usually increases if the company you invest in performs well and develops. For instance, you have doubled your money if you pay $15 for a share, then sell it for $40. Many investors search for businesses they think will flourish throughout the years. Conversely, dividends are payments certain firms make to their owners out of their profits. These little consistent payments, which serve as compensation only for stock ownership. Although not all businesses pay dividends, many big, steady organizations do, and it's a common approach to make money on top of the increase of the stock. But how can you really decide which stocks might bring you profit? We will discuss some techniques coming up next. 3. Knowing stock market risk. Now, even though the stock market could increase your wealth, you need to also keep in mind that it has hazards. Though they might also fall, stocks can rise. For example, if a firm fails, the value of its shares can drop, therefore you might lose part of the money you put in. Although this may sound a bit frightening, risk is really natural in investing. Key is knowledge and control of it. There are certain stocks more risky than others. Though they can be erratic, smaller, younger businesses may offer great promise. Established businesses, however, are frequently steadier but may not expand very fast. Distributing your money around several companies or even different kinds of assets, such as bonds or mutual funds, is a smart approach to control risk. Diversification helps guard your assets. Thus, if one stock declines, another could counterbalance things. How therefore could one strike the mix of risk and reward? Let us next discuss the several kinds of stocks and how to choose ones fit for your objectives. 4. Kinds of stocks you should purchase. The stock market isn't one size fits all. Knowing which of the several kinds of stocks that fit your objectives will enable you to make wiser decisions. First, there are common stocks. That is what most people understand when they hear stocks. Purchasing common stocks entitles you to a little portion of the business and will benefit you if the firm does well. Then there are preferred equities, which typically pay dividends and are sometimes regarded as less risky, but do not appreciate value as rapidly as common stocks might. Stability and growth potential of stocks provides still another perspective. Popular among those who like to see their investments rise rapidly, growth stocks are shares of businesses predicted to surpass the norm. Still, growth stocks might carry some risk. Value stocks, on the other hand, usually come from steady businesses with a strong past performance. Long-term investors find these appealing, even if they might not develop as quickly, since they provide consistent returns and are usually priced less than their real value. But if you would rather not choose specific stocks, we will then explore a method to invest in the full market at once without having to deal with individual stock selection. 5. Index funds and ETFs. You're not alone if choosing particular stocks sounds taxing. An easier approach for many individuals to participate in the stock market is with index funds or exchange-traded funds. These are stock sets reflecting a particular segment of the market. An S&P 500 index fund, for instance, features shares from the 500 biggest American corporations. Investing in this fund is therefore like investing in all 500 companies at once, distributing your risk and you a piece of numerous profitable businesses. Index funds and ETFs primarily help you since they are diversified, thereby distributing your money over several stocks rather than just one. Usually, they also match the success of the whole market, which has long-term trended upward. For individuals who wished a set-it-and-forget-it strategy, or for beginning investors, this makes them a popular alternative. How then exactly do you need to start? How much cash? Let's next analyze how even modest contributions might increase over time. How much money should you actually invest? One of the most false ideas regarding investing is that starting requires a lot of money. The truth is that starting with as little as a few bucks will help. Fractional shares allow you to purchase a small fraction of an expensive stock instead of a full share. This implies that regardless of your budget, you can access even well-known companies like Apple or Amazon. Starting small is an excellent way to ease into investment and get confidence in the stock market without risking more than you are prepared to lose. Moreover, compound interest lets even a tiny quantity expand dramatically over time. Regular monthly investments will help you see your money start to work for you, progressively creating wealth with less risk and less stress. But if you're a novice and you worry about making mistakes, let's then discuss typical beginner errors and how to prevent them. 7. Typical mistakes new investors make and how to prevent them. Although beginning in the stock market can be intriguing, beginners should be aware of some typical mistakes. Among the major errors is attempting to time the market. Many new investors get caught in the ups and downs, believing they can forecast when the market will rise or fall. The pros cannot, however, consistently time the market either. Investing consistently, regardless of market conditions, which is a technique known as dollar cost averaging, you are thus averaging out your expenses over time and purchasing at both the highs and the lows. Investing all your money in one stock is another typical error. Imagine putting all you have on one horse in a race. Reducing that risk is mostly dependent on diversification. That is, spreading your money among several stocks, sectors, or funds. And ultimately, be cautious about hot tips or stocks that are social media trends. Although they would seem to be a shortcut to quick riches, they can sometimes be erratic and dangerous. We would be happy to hear from you in the comments. What most concerns you regarding investing? Alternatively, if you already invest, what has been your most important learning thus far? Let your ideas fall down below. Remember to hit that like button and subscribe to keep informed on our most recent material if you liked this video and found it useful.